Hi, this is Mike Maloney, and I've got some more potential evidence that the stock market is trying to begin a crash. This is the dynamic yield curve. This is available at stockcharts.com, and it's quite an interesting gadget. I've shown this before, at least to my insiders and so on, but you can play this automatically where it sweeps. This is the S&P 500, and the day that it sweeps through this red line sweeps through the S&P 500, it's displaying what the yield curve was. In other words, the yield that the 3-month Treasury, the 2-year Treasury, the 5-year Treasury, the 7, the 10, the 20, and the 30-year Treasury. And there's something called a positive yield curve and an inverted yield curve. And a positive curve is where short-term rates are lower than long-term rates. In other words, people are charging you, they want more interest on their bonds if they're going to loan the currency for 30 years versus 3 months. One thing that you've probably heard about is a flattening yield curve or inverted yield curve. You might hear that on one of the financial news channels. Well, if you watch this yield curve, it's positive right now, and now it's flattening. And then right here at the market peak, it goes inverted, where people will demand more interest to loan their currency for short periods of time to the government than to loan it for 30 years. That suggests that there's a high degree of nervousness in the markets. And so it goes in your inverted, and then the market starts to crash, and it goes back to a nice positive curve. These positive curves are much more healthy than a flat or inverted curve. An inverted curve means that investors are really worried. Now, if you notice over here at the 30-year, it bounces up and down with the rest of the rates until a point here where it's fixed. Now, it isn't because it's fixed. It's because Alan Greenspan actually stopped, during his tenure, they stopped issuing the 30-year bond. And then it starts again when they reintroduce it. But notice it's going from a very positive curve to a flat curve to an inverted curve, and then the market crashes again. So this curve has been a predictor in the past of market crashes. And the thing now, though, is that they pegged the rates, the 3-month, the short-term rates, are pegged down near zero. Now, they've let it float up a little bit, but not much at all. So you're seeing a positive curve here, and then we're seeing the high end, the long-term end of the curve start to come down compared to the 7-year and 5-year. They're not that much higher than it. Now, because the bottom end of this spectrum is pegged, it can no longer invert. But what you see here, here's the latest data, and it's really trying. Compared to the 30-year, the difference between here, it should have a real nice healthy curve to it. This is getting much flatter. And if they come out with more QE, the QE forever, it's QE forever, you will see the markets probably take off again. Except each time they do this, it requires more and more energy. They're using up their ammunition on these things. And the last time they started QE coming out of a recession. The recession was from here to about here, and they started QE over here, causing the bottom to put in an early bottom. It probably would have crashed quite a bit more without the QE. But then in my last video, I show an overlay of base currency as excess reserves with QE on top of it, and the correlation is so close that it's an impossibility that the markets weren't levitated by this QE, and that they're much higher than they normally would be if there hadn't been all of that currency created and put on the bank's balance sheets. So this is just one more indicator. And the thing is, these people, they're not going to admit that they are at fault. When the consequences of their actions are revealed, they're going to blame it on the free market and not themselves. But these manipulations don't allow the economy to clear properly. It doesn't allow excesses to be wiped off the books and start again fresh. It keeps things in bubbles, and the bigger the bubble is and the greater the manipulation is, the worse the reaction is, the consequences from their manipulations. So this is, again, just more evidence that I think the stock market top is probably in, unless we're in for QE4, QE forever, and even that will fail one day. It might get the stock markets to rally a little bit for a little while, but they're going to be trying to do QE going into a recession instead of doing QE after the recession is over. So it's a whole different set of circumstances this time around. That's it for this video. Thank you very much for listening.